I'm Lester Martin. I'm going to provide another video session on parts of the retirement decks. In this particular case, it will just cover 2 or 3 slides, but they will be rather detailed slides, and they are related to the breakdown of medical expenses and the various ways that one has created pre-tax for those, and the extent to which the medical expenses are in fact transferred or transferable into itemized deductions on your federal or state income tax. So I've created this slide to show a variety of the pieces, so to break down the medical expenses, and this reflects medical expenses and various types of ways that those are covered by pre-tax. And this is an example of the way it would be done during a year when a person is for part of the year, one or more of the people in a family are in fact covered by AT&T high deductible insurance, and therefore by flex, and part of it by other parts of the year whenever it's covered by Medicare, and therefore that makes this much more complex. And I will say that one would have to have fairly large medical expenses to actually itemize, given the way that the pre-tax structures are. So the first one that one encounters is flex. That is, whenever you're buying, when you're getting your flex benefits from AT&T, some of the items are covered by are listed as pre-tax, and some of them as post-tax. And so if they are in fact pre-tax, then those are expenses that, because they're covered by pre-tax, are not able to be itemized. So that's one of the items. The second is covered by an HSA, or a health savings account, and this HSA is designed such that it has a relatively large amount that's allowed each year, perhaps for 2 people, $6,500 or $7,500 depending on your age. An HSA is useful for a high deductible insurance, and you contribute pre-tax money into the HSA, and then you use that money to cover medical expenses. And as such, then those medical expenses that are in fact reimbursed by the HSA are in fact things that cannot be itemized. Now, up here, I'm going to go through, there are medical expenses, there's dental expenses, there's medical, dental, and vision insurance premiums. And so those are expenses that would, under certain circumstances, be itemized, could be itemized in a deduction. However, when you're an employee with AT&T, then those are in fact typically pre-tax, covered by the flex, and therefore that would be to the extent that flex covers them, to the extent that flex is large enough for that, those would not be deductible. There's also then medical expense, the deductible and the copay. And so both of those, once again, they're not covered by the flex, but they may very well be covered or reimbursed by the HSA, which was pre-tax money. And therefore, that's the reason that these are connected together. And then there's medical expenses that you have, that is copay, and copay, if you will, are the 80% perhaps that actually is paid by the insurance itself. And once again, that's not deductible if the insurance is paying it. So if Flex is paying for it, it's not deductible. If the insurance is paying for it, it's not deductible. However, to the extent that it's not covered by the insurance, like the deductible and the copay, it might be if it's not covered by HSA. Other are medical expenses, maximum out of pocket, in and out. So if there is a limit and if it exceeds the maximum out of pocket, then it would in fact be covered by the insurance itself. And so once again, it's not covered by HSA. Another thing would be covered by the dental plan. So over here, you've paid for the dental premiums. Here, typical dental plan covers some items, and those expenses that are covered or actually reimbursed by the dental plan are not deductible. However, there's some parts of a dental plan, like the copay and like the deductible, that are not covered by the dental and therefore are covered by HSA. Likewise, there's vision expenses. Vision, one thing to be cautious about is that vision actually covers two different kinds of things, and some things related to your eyes are in fact medical, and so they fall under this part over here. Others fall under vision plan, and that would be what it costs to actually for the evaluation of the eyes to create a prescription, and also the cost of the of glasses or contacts. Now, because those vision expenses, some are covered by medical. That is, it's actually paid by your medical insurance, the high deductible, or by Medicare. Others are covered by the vision plan if you have it. Some people choose not to have a vision plan after you move on to onto Medicare, because the vision plans are cost enough so that the amount that they reimburse simply is not viewed as being worth it. And then there's some things that are not covered by the vision plan, and whether you have it or not, if it's not covered, then potentially it's covered by the HSA or the health savings account. There's also long-term care, and if you have that, and while you're an employee, it is not pre-tax, it's post-tax, and therefore it is potentially deductible if it's not covered. And then there's and so there's the premiums. And once you move into Medicare, then the premiums are perhaps paid through your bank account instead of out as a withdrawal, but they're still expenses, and they're not pre-tax, and therefore they may be deductible unless you're paying for them with a HSA. Down here, there's concierge. I'm not going to go into the detail of what that is, but generally, there's regular and Medicare versions of that, and I believe that concierge, because it's not really medical per se, but rather is a structure to allow you to get appointments, is not covered by Medicare. I don't believe that it is covered by HSA, and I don't believe that it is covered by the HRA. Now, so we've talked up here about Flex. We've talked about the HSA, and the third or next type of reimbursement is the Medicare HRA, which would either be $2,700 or $1,500 per year if, in fact, qualify for retiree health insurance. Now, notice that whenever you get to Medicare, there is Part A, which is free. There is Part B. There is Part D. both B and D are in fact do cost you something. There is Medicare Supplement, which is also a Medigap, and then there's dental and there's vision, which you have also. All of these are separate, and each one of them has an expense. And to the extent that that you have enough, the HRA can actually be used to pay for each or all parts of this. My experience is that the HRA was enough to pay for Medicare Part D and a supplement without really much left over for the dental or the vision or the Medicare Part B. And that means that the parts that are not covered by the HRA in this particular case, as well as the long-term care, are in fact reimbursable. Now, once you have that and you put them into your tax, for federal purposes, that amount has to exceed, I believe, either 7 or 7.5%, depends on the year, and before it's deductible. And for the state, it's 2%. So you may very well not exceed the 7%, but it might still be worth your trouble to itemize the deduction and put it on the so that it flows through to the state, and you get some reimbursement from the state for the 2%. In fact, that's happened with me. One case where there was none here, but there was some there. So these are the three types of pre-tax structure: the HSA, the HRA, and what happens during flex. And so now I'm going to move on to the next slide and talk about an Excel program that I built, which I use to deal with all of these types of things in 1 year. This is just an example. The numbers are not particularly meaningful. Now, notice up here at the top, there is the AT&T high deductible Medicare, and the categories here are in fact whether they're premiums or labs or drugs or doctors or and all of these occur during either Medicare or in HD. Your HD, if you pull that off the medical, it will break it down this way. And so this is important because in order to put it into your the itemized deductions, you need to be able to break them down. So the first two categories up here are in fact premiums. The HD premium for one, if there are two people that are covered by this, then it would be both of the people. If it was one person that was covered by this and otherwise covered by Medicare, then you would have, and during a year you might have one or the other for various periods of time. And so given these categories, then you have the monthly growth that it costs for that, the number of months in 2015, 2016, the amount paid, how it's paid, whether it was paid by a pay stub or checks or coming out of Social Security or some other method. Now, the next category shows what type of pre-tax mechanism is used to pay for that, and therefore what is going to cover it, and before you're allowed to itemize it for IRS purposes. So up here you've got the premiums during a time whenever it's covered by the high deductible, and so the HSA, I'm sorry, the flex is what pays for the premiums for this, and then the HRA is what's used to pay, can be used to pay for I'm sorry, the HSA can be used. And so then there's an amount there. So the first ones are related to the premiums for the high deductible. Then we move down to the high deductible that comes from your, when you download from the medical insurance company on labs in each one of these categories. All of these are in network. All of these are in HD network. If anything was out of network, then that would be a different situation. The doctors may be useful just for recording purposes. Once again, whether one person or the other, annual, the gross amount for those, and in this particular case, whereas up here, Flex was what was covering you. Down here, HSA is what is actually covering the cost of this to some extent. But in this particular case, the HSA was not large enough, wasn't to pay for all of it. And so this was the amount that was remaining that could be IRS itemized in this fake example here. If we move on down, then there's also other, for instance, there's drugs and dental and vision, and these are these things have various amounts of insurance, or in one case, over the counter, which is not deductible, dental copay, dental copay, and vision copay. And once again, these are covered by HSA, and then there's an amount that might be, if these were as large as they are, then there would be an itemized, IRS itemized amount remaining that could be deducted. Now we're moving down to the point where you get to Medicare. So somewhere during the year, different years for different people, you have Medicare expenses like drugs and doctors and premiums. The premiums tend to be paid by the HRA. The drugs and the doctors deductibles and copay could be paid by the HRA if there was enough, but it may not be. The HRA typically is not enough to pay for all of those. So this is showing what it could do if there was a large enough amount in the HRA. And once again, these are the amounts that that are useful for deduction. And then these are showing whether this was deductible and copay or hospital, drugs, doctor and hospital. The reason, as I said, is that this will then flow through the model down, and I'm going to move down to the next page. And then the last part of it are the is some summary stuff that we have down here, and this is a summary on the HSA and the HRA and the summary of how much they are, and therefore the total summary, which is showing how much is actually deductible, in other words, net. So the gross was 15, the net was, in this case, was 14, and now down below, bits and pieces of these two pages are in fact then brought down here, summarized as drugs and doctor, lab, etc. Because on the itemized deduction page of your taxes, there are categories where you need to put these numbers specific for these things rather than just a single number of 14,000 or 1,000 or whatever premiums. So all of these categories are on the page of the itemized deduction, and this sum is basically the same as this sum. There was a slight difference that was dealt with in the tax. So this model would be usable. You'd simply have to fill in the pieces, and it's available if you want to get a hold of it. If in fact you have this much complexity, and if you have significant income. significant medical expenses, and you want to try to deduct some of that from your federal or state. So that's all that I have on that particular topic. I'm going to stop at this point. Once again, Lester Martin, 732-533-9290, or Lester R. Martin at gmail.com. Thank you.